Hello, and I'm Alison Blanchard and welcome to my Smart Business course, and tonight we're talking about smart structures. Now I'm not talking about buildings, I'm talking about what you should run your business under. So first of all, I'm going to talk about a sole trader. So a sole trader is a person who is operating the business themselves. They are it, the buck stops with them. They're the ones who will pay all the taxes, they'll be the ones who make all the profit. They cannot take a wage with tax deducted off it. So what they do is they take their profit. So they might make 50,000 income, and they might have 30,000 of expenses, so that'll leave them with 20,000 worth of profit. Under a sole trader structure, that profit is basically all taxed in that person's name under their individual tax rates at the time. So in New Zealand we have a staggered individual tax rate system. Other countries it could be quite different, but it's not just going to be say 10% of that or 20%, it's going to be a staggered rate, and that would get put into that person's income tax return and added to any other income they may be earning. That sole trader, for example, after year one, can take out $20,000. That's their profit, they've earned that. That in fact is tax included profit because they've got to pay their tax out of that as well. So when you talk about a sole trader trying to get money out of their business, we talk about drawings. Drawings is basically taking your profit out during the year to live off. Some people say you get taxed on your drawings. In a theory you do, because this is supposed to be what you're drawing out of your business to live off. Sometimes you may take more because you haven't made such a good amount of money in the first year, or you may take less. You may have had to put money into your business to get it underway and keep going. Any money that you put into your business yourself is called, what I call it, capital introduced. And that is not taxed. So any personal money, it's okay, any personal money that you physically put into your business, into business account, is capital introduced by you and therefore can be drawn out at any time later, not taxed. Yep.
So if, for example, you were setting up a business and you're buying things before you actually get going,
yes,
and you're using your own personal money,
yes,
for your wages, if you keep all the receipts from that,
you can get that reimbursed.
And can you get the GST, when you put in your GST?
If you're GST registered, yes, you get to claim all of those back for GST.
Right.
So if you
do your GST every 2 months, can you do it in the first 2 months?
Yes.
Oh, yeah.
Yeah.
Okay.
So that's if you've spent your own personal money for business assets, and you're GST registered, then you can claim the GST on those items. It doesn't have to go through the business account.
Right.
Yeah.
Okay.
Just keep the receipts for that.
Yeah.
You have to be GST registered first though, and then anything you buy after, or?
You can backdate up to 6 months for GST registration. So if you have a business idea and you're buying some things and you start 2 months later, you could backdate the registration period to encompass that area.
Right.
Yep, so that's fine. If you've got some items, you bought them 1 month, you probably could say, well, you know, I bought them for the business, and if it's not too far removed, then we can probably put it in. That'll be fine. So just remember that drawings is you taking personal money out of the business to live off. In a sole trader situation, it's also probably going to include their tax they need to pay to the tax department. But any personal money you put into the business is not taxable and can be drawn out as well. The idea of your business, how I see a business is it should be making money. You do a business because you want to make a living out of it. You go into business because you don't want to work for somebody else, in theory. So therefore, if you need to earn a living, then you need your business to be making a profit. But it's knowing what profit you want it to make, and also taking into account that there's some tax to pay on that profit. That's the most important thing. So in this situation here, I would say to this sole trader that 10% of the turnover or income that they've received, they should put aside into another savings account to save for their tax. Now 10% isn't the correct tax rate, but in my mind, it's actually a good starting point, that from day one when you start in business, if you can put 10% of your total income from your customers into another bank account, then you are saving for your tax as you go. Because you won't physically pay tax in the first year of business, but you will certainly be taxed in the first year of business. It'll just happen a year later. And in the second year of business, you'll be taxed for the year just gone and the year in advance. And that's called provisional tax.
So just the 10% is there is also the GST.
No, that's just for income tax.
Okay.
Yeah. And I would recommend that you have a business bank account and a business savings account so that that tax money can go into there. If you're GST registered and you want to save your GST as you go as well, you could put that into the same savings account, and the GST rate currently is 15%. Bear in mind though that you get to claim GST back on your expenses if you're GST registered. So therefore you're claiming 15% on those business expenses as well. So if you're wanting to save your GST, if you were to save 15%, you'll be saving more than you needed.
So Alison, if you got a tax refund
Yes?
and that goes into the business account, what's that classified as then?
If it's a sole trader, it'll just be called capital introduced. If it's a limited company, it would be called, it would go as income tax. So it would be like a provision for tax account.
So it's capital introduced that you could, so effectively you're then claiming it back
Absolutely.
yourself.
Yeah, you could use it again.
Yep.
Because if you're a sole trader, that tax refund is your refund anyway.
Yes.
But if it's a limited company, it's not your refund, it's the company's refund. So it's quite different.
You'd always be GST registered pretty well, like this.
You don't have to be. There are some industries that are exempt, so they don't need to be GST registered. There are some industries that the people may not earn up to the $60,000 threshold, which is the threshold for GST compulsory registration at this point.
Right.
And some people may, they're quite happy to stay under 60 and it may be not worth them registering. So there's some lawn mowing people out there, for example, who just, they won't earn, they don't want to earn 60,000, and because they're competing with so many other people who aren't GST registered, that it's easier for them not to be, because otherwise their prices go up by 15%.
And that's $60,000 income or $60,000?
Yes.
Right, not profit.
No, it's just income.
Yeah.
And it's income from the business. So if you're a sole trader and you earned 50,000 worth of income in this example, but you also had a job, a part-time job just to help with the money for the family, and you earned 15,000 a year in that, you don't need to be GST registered. It's strictly on what the business earns, not any other income.
It probably sort of depends on what your likely expenses are going to be as well.
Correct.
Like if you're under 60,000, but you're buying a lot of things that you're going
Yeah.
to be able to get your GST returns
Yeah.
on, then absolutely. But if you're buying a minimal amount of things,
That's right. If you're having to spend a lot of money on capital expenditure to get your business up and running, I would recommend GST registration, because then you would get a GST refund back, which helps with cash flow.
Right.
Also, I'm of the mind that if you restrict yourself to 60,000 a year, you're restricting your mindset, restricting your business. I mean, some businesses that might be all that they were earning, and people are quite happy with that, absolutely fine. But if you say, oh, I don't know if I want to be GST registered, I'll just stay under the radar, you actually stop your business growing. But in some startup businesses, it could take a couple of years to get to that point. I'm just thinking of the Celebrant, not picking on you or anything, but just saying with the Celebrant business, it's going to take a wee while before you're flat out.
Yep.
So, and because it's a service you're doing, there's no point being GST registered yet, because you're just going to be paying GST every time you do a service, and your startup costs aren't big enough yet. Mm. So that's sole trader, and we are going to talk a little bit, obviously GST as well around this whole thing. So I'm not going to write a whole lot up about GST, but GST we will actually we'll touch on that. I'll just quickly go through GST exempt. See some examples of expenses that do not have GST on them. Bank fees, interest, hire purchase and loan payments. If you are purchasing a large asset, say a vehicle, and you're going to pay it off through a loan or a hire purchase, you get the GST back on the upfront amount, even if you haven't paid that whole amount to start with, even if you're paying it off. So the GST rules will say that if you're buying a vehicle worth $40,000, but you're going to be paying it off through a loan at HP, you get to claim the GST on the $40,000 as soon as you enter the contract. But you do not claim GST on the payments. Drawings, no GST, because that's your personal spending. So drawings or any personal spending, no, you cannot claim GST on, even if GST is factored in that cost, because it's not a business-related cost. Tax, there's no GST on tax. Apart from fringe benefit tax, there is. That's the one exemption. There is no GST on GST, and some people laugh at that, but I have seen people claim GST on their GST payments. Wages and PAYE, there are no GST. So what you need to be checking is looking at the invoice that you receive when you're paying for something, and making sure GST is in that invoice, because you may be dealing with a non-registered person, a non-GST registered person, and if they're non-GST registered, they cannot add GST onto their invoice. And if they haven't added GST onto their invoice and you are registered for GST, therefore there's no GST for you to claim, is where I'm going with that. So you must look at the invoices that you receive and find out if there is GST on them. Because there can be subcontractors who might be doing work. I'm just thinking at the bee farm. Can we call it a bee farm?
If you, like I know when you invoice, like if we're purchasing, say, drums,
Yes.
and you would be invoiced for the drums plus GST, and usually for the transport costs as well. Now the transport costs often invoiced in the invoice, the GST will be like done over, this isn't actually specific, that's just an example,
Okay.
but the GST will be done over for the drums and the transport added together,
Yeah.
plus GST.
Oh no, that's fine.
That
Yeah.
makes sense.
That's fine. It's just if you had someone coming in to cut the lawns around the beehives who wasn't GST registered,
Yeah.
you wouldn't be able to claim GST on their cost if they haven't charged it. Also, you are not allowed to charge GST on your service or good that you're providing if you're not GST registered. So there are some people who've thought, oh, everyone's doing this plus GST thing, I better do it, but even though they're not registered for GST. So when you are registered for GST, you need to put your GST number on every invoice. And your GST number is the IRD number that relates to your business structure. So sole trader, the IRD number is your personal IRD number. For a partnership, it has a separate IRD number. For a limited company, it's a separate IRD number to the individuals. But as a sole trader, it's that person's IRD number. Yep, so for a proper tax invoice, you must have the name of the business, the GST number, must have the words tax invoice on it, and it must show whether the GST is included in the total price or whether it's separated, like total amount GST and then the total to pay.
What are your thoughts on staggering your income, like deliberately staggering your income to, like I know the aim is to make a profit, absolutely, but like if there's a means to, say, only earn X amount in one financial year, therefore not be paying as much tax, and then stagger it into
I
the
can
next
give you
year.
IRD's viewpoint on staggering income.
Certainly.
IRD would not look on it favourably if it was not an industry-specific income staggering scheme. Is everyone okay with GST? Great. The Inland Revenue has a great GST guidebook. It's very useful, and you can get quite a bit off the website as well. So that's sole trader. I'm just going to rub the GST bit off and talk about partnership. Okay, so with a partnership, that can be with 2 people, can be 20 people in a partnership. In this current scenario here, under a partnership structure, the $20,000 would be shared. So if we had 2 people in this, and this profit here of 20,000 they earned, then they would get 10,000 each, which would then go into their individual tax returns. In a partnership, there is a tax return done in the partnership, but all that tax return does is tell the Inland Revenue Department who gets what split, and then the taxes are paid in the individual's tax returns, not the partnership tax return. So in this case then you can see, well, 10,000, I mean they haven't made a lot of money, so I'm sorry, I should use larger figures, but the tax on 10,000 is obviously a lot less than the tax on 20. So as that business grows over time, a partnership structure could be quite advantageous because you're splitting the profits and thus reducing the overall tax exposure. Normally a partnership would be a 50-50 split. If you want anything different, you have to have a partnership agreement. The partnership can be GST registered in its own right, so obviously it's doing a business structure, it'll have its own individual IRD number, separate to the partners who are part of the partnership. So when a GST invoice is created, it would have the partnership IRD number on it, and not the individual people. And the individual people who are partners in it do not have to be GST registered themselves, it's just their entity.
The partnership, we'll say 2 people,
Yep.
they're not employees as such, they're
No.
just,
They can be, in a partnership structure you can be an employee, but you have to have a contract of service written up to state that you get paid for this amount per hour for this type of work, and that PAYE will be paid.
Yep.
So you can get
and then
paid a wage.
at the end of that, whatever profit is
Split and as per the partnership agreement or as per 50-50. With a partnership, you are jointly and severally liable for any debt of that partnership. So if you are to go into business with somebody in a partnership structure, be very careful and make sure that you trust them completely, because if one of you takes off with some money and leaves the other one behind with all the debts, then that person's personal property can be seized to pay for that debt. Also in a sole trader situation, obviously the buck stops with this person. Their own personal property could be used to repay debt if the business went under. So a sole trader would be made bankrupt, for example, if they couldn't pay their debts. In a partnership structure, the partners could be made bankrupt if the partnership went under. Liquidation only comes into play when it's a limited company. Same accounting rules apply for both of these structures. Nothing really changes apart from that you'd have what we call partner current accounts. So there'd be A and then B, and under that would be partner A might have put some money in, but partner B didn't. So we separate exactly who's put what money in where, so that if there's an issue, each partner knows who's put what money in, and also how the profit was split. So in when I do financial statements for a partnership, I will show what we call partner current accounts separately, so that each person knows what's going on and who's owed what at the end of the day.
And so that's the same for drawings as well?
Yep, so drawings can be
or
taken.
capital
Yep,
introduced.
that's
Yeah.
correct. So if in a partnership structure, if they're not doing a contract of servicing, taking a wage, then they will take drawings out, in theory, to equal their share of profit, or to equal what they've actually put into the business as well. If you are in this type of situation, a partnership or a sole trader, and you have personal property, the really only safe way to protect that personal property is a trust, a family trust. Not a trust that you would use for your business, but just a trust structure that holds your house or your vehicle, if you wish, if it's not a business vehicle, or holds all your personal property. Now that trust doesn't have to have an IRD number, it doesn't have to do a tax return, it's just an entity to protect your personal property. If it's in a trust, you don't own it, is what I'm getting at. You need some legal advice on setting up a trust, and you need to really check when you set up the trust. Your property won't be immediately safe. There's a clawback, so the lawyer will talk to you about how many years it will take to be safe completely. But sooner rather than later is what I usually suggest.
Digressing from this.
Yes.
A thought I had during the week was around the expenses, so you can claim your mortgage interest.
Yes,
So if the mortgage is in the name of the trust,
yes, you still can.
cool.
Yep, no, that's absolutely fine.
Would it be the sort of thing, in regards, we'll say staggering income, if you were going to, you have your mortgage for your lower value house, but you know in 2 years' time you're going to be purchasing a slightly more expensive house, is it the sort of thing that would be?
Yes, you'd set the trust up first, and the trust would buy it.
Yeah.
Yep. You get a lawyer involved to do the trust deed and all the documentation, and then you'd need to get the lawyer involved to say, if you're borrowing the money based on equity you've had in the past, then you might have to gift that equity over to the trust, or somehow you want to do that. Always get a lawyer involved when you're dealing with trusts, especially if you've got children, because you're trying to safeguard those assets for your children for the future as well.
Mm.
And there's no drama with if you put your house in trust, then you can still, for us it will be putting it in trust for our son.
Yep.
But we could then still sell the house and
Oh, absolutely.
and buy,
Yep.
so it doesn't make a lot more paperwork or
If you have an independent trustee and it's the lawyer, that any time you do a mortgage or need to borrow against that house, or you shift houses or sell them, the lawyer's always got to be present to sign the trust documents as well,
Right.
because they are an independent trustee. You do need to document a bit more when you have a trust. You need to do resolutions and make sure everything's still current, the value is still current. Because the issue comes back to your children. When they turn 18, they might go, oh, so we've got a trust, have we?
Yeah.
So
That's exciting. What did you do with that money, Mum?
So let's say the house gets sold, the money from the house then ends up in the trust.
Yep.
The trust, anybody who is
Beneficiary.
the beneficiary can draw.
It depends how the trust is set up, because you can have discretionary beneficiaries, you can have normal beneficiaries. Depends if you've decided within your trust deed that capital distributions are allowed, or is it just income distributions. That's why you get the lawyer involved to work all that out. But if you've sold a property and it's capital money you've got there, then a capital distribution can be gifted out or given out, and that won't be taxed, depending on how that capital distribution came about. So it's not clear cut, but you can do that. But I'm not trying to scare you. Trusts are quite simple to use. but it does involve a bit of documentation and a lawyer.
That's all right.
But you do not have to have an independent trustee. That's not a requirement by law. You can just run it yourselves. But do document, you have to document things anyway, because obviously your child will be a beneficiary of that trust and they may ask questions later.
Mm.
Or not. Probably not.
I'll never know.
Well, that's correct. They'll never know. That's the correct answer. Okay. Any questions on partnership or sole trader structures?
I was just thinking from me, which probably it would be a partnership thing with this one. But one of my concerns is essentially that if I injure myself, I can't do my job.
Correct. Yep.
ACC or the sole trader or this model it doesn't really offer much unless you're actually an employee. Initially, it doesn't sort of make sense to be an employee, but that
You
would
can
be
get
the-
Cover Plus Extra though with ACC, where you can agree upon a figure
Yeah.
that you wish to be covered for should you have an accident.
Okay.
And that could be quite beneficial, especially in the first few years of business, because you may be building this business up and it's not making any money, so you're not necessarily paying a levy.
Yeah.
But if you agree to say, look, I need to be paid out $40,000 should I injure myself over, that's the kind of salary I need to be earning to keep my family going.
Yeah.
If you do that, it's called Cover Plus Extra. And then it's like an insurance policy with them. They'll say, yes, we'll cover you for that amount. This is how much you'll pay per month or as a lump sum, and then you're covered. So if you have an accident, then you don't have to go through the rigmarole of trying to verify your income. You've already agreed an agreed figure.
Yeah. So
With
you give them
ACC.
a call, have a bit of a chat about it. And
Yeah.
Yeah.
So that probably would be where I'd recommend that you go with that. Okay. Company. With a company, in New Zealand, it has limited or LTD at the end. That stipulates it's a company. In New Zealand, you have to come up with a name that's unique that no other company in New Zealand has before you're allowed to register a name. So you can go into the company's office website, check out some names. If you put what you want, if it says there's nothing like that there, then you can reserve that name. Currently, it does cost a fee. So at the moment it's $10 to reserve a name and $150 to incorporate a company. That's just the company's office fees, and you can do it all online if you wish. At the same time, when you do that, you can register and get an IRD number for that company, and you can also do GST registration at the same time as well. With a company, the tax department considers this a separate entity to you as a person. The company must have a shareholder and it must have a director, at least one shareholder and one director. A director manages the company, looks after how the day-to-day business running goes. The shareholder is the investor of the company. So they're the ones that own the company. And the rules for one person having a company versus a whole heap of people investing in a company are very much the same across the board. So you might get your telecom, for example, that has a board of directors. They may not own shares in that company, but they run that company. But, so I'll just use you two, for example. You may own a company, you're both shareholders, but you can both be directors at the same time. As a director of a company, you can be held personally liable for the debts of that company if you mismanage that company.
Even if you were no shareholder.
Correct. Even if you weren't a shareholder. A shareholder is limited, their liability is limited to the value of their shares. So if something went wrong and you're just a shareholder and not a director and the company has to be liquidated, you can be called upon to pay the value of your shares at that time. which might not be very much, could be $1. So doesn't always get called upon. So a shareholder has a limited liability, that's why they have limited in the end. A director does not.
What recourse do shareholders have if they're dissatisfied with the
Directors?
directors?
Yep, they can take them to court.
Right.
Which you would have seen in the news over the last few years about the finance companies and how you're seeing all these men in suits sitting in the docks because they were directors of those companies and they are being taken to court for mismanaging the company's funds. And some of those have been civil actions, so that means that the shareholders are taking them, or some of it's criminal, depending if they can prove fraud or not. With a company, you must complete a company annual return. This is separate to a tax return. This is an annual return with the company's office every year, just letting know that the company's office know that yes, the address is the same, shares are the same, everything's the same, yes, we still want this company name. You also have to have a tax number, IRD number, and it is separate to the shareholder's IRD number, so it's a completely separate person in the eyes of the law. Company can be GST registered like we talked about before, and of course that would put its own IRD number or GST number on the top of every invoice. The company name does not have to be what you trade as, and that's the same with sole trader and the same with partnership. You can have a legal name, which obviously the sole trader is your name, but you can trade as something else. Partnership can have the partnership name but trade as something else, and so can a company. So the good thing I like about a company is that you could probably have many different businesses under the one company and trade as something else. It gives you flexibility. I always like to keep businesses separate if we can, because if you decide to sell one business and keep another part of that business, it's very, very difficult to separate the figures in the reports to say, well, actually this business only made this much, whereas this one made this much. So if your long-term goal is, I'll work this business and I'm going to sell it in 5 years, but I also want to do something else as well at the same time, I would have a separate structure for both. But if it's not an issue that you're not thinking of selling it later and you think it's quite a good idea to blend the businesses together for whatever reason, then you could put them both under the company structure. And that's perfectly fine too.
Right.
It doesn't matter if one business is making a big loss and one business is making a big profit. If you want to put them both under the one company, you can.
But you can't do that with a partnership model?
You can do that with a partnership model. But the problem with that is that joint and several liability under a partnership model. I mean, if you're thinking of yourselves, that would be perfectly fine. I mean, but if you're doing it with somebody else, you'd be jointly and severally liable for their other business too.
Yeah.
Whereas in a company structure, you might say, well, we're just going to be shareholders and someone else is going to be a director and get them to manage our affairs better. Then you've got separation of duties, so then it might work okay. Also, like in a partnership, you'd have your shareholders, so A, B and C shareholders. You could have as many shareholders as you wish, there's no restriction there. But if you had 3 shareholders and they might put money in, they might draw money out, so they have these separate what are called shareholder current accounts, just like a partnership has a separate account so they can see who's introduced money in, who's drawn it out. Has there been a dividend? Companies distribute their profits through a dividend, or they can issue their profits out through a shareholder salary. A shareholder salary can just be looking at, say, there's $20,000 profit here, we're going to give shareholder A and shareholder B $10,000 each as a shareholder salary. Shareholder C doesn't want anything at the moment because they're just staying passive. They haven't done any work in the business, so we're not going to give them any remuneration for their work. And you can do that in the company. You don't have to stipulate to an agreement. It doesn't have to be as per their shares. It actually has how much work they've done in the business.
So that's decided by your directors.
Yep.
So there's no, so A and B get 10,000, C doesn't necessarily get 10,000 at a later date, it's just,
No.
that's it.
Yeah.
And that's a shareholder salary, which is separate from, like if it's separate from a director,
Director's remuneration, yeah.
yeah, it's a separate.
Yeah.
Right.
So also, as shareholders, they can earn a wage with PAYE deducted. They can be an employee of the company, and there doesn't have to be a contract of service. You can just be an employee of that company.
Yeah. And then you're still able to get your
And you
shareholder
yeah, if you
dividend.
want, yeah, you
Yeah.
still get a dividend if there's any money left, or you can still get an extra shareholder salary on top. But you are restricted. There's some rules around that. So it's best to talk with your accountant at the time about how you want to do that. But yeah, there's no requirement for everyone to get the same, is what I'm saying. There is when there's a dividend. A dividend is given out as per your shareholding.
I guess when, so essentially when your tax returns are done, it has to be quite clear with where the expenses paid to the individuals,
Yeah.
why the money's gone to this person.
Yeah.
Was that this, was it this, was it that?
Yep, and that's a discussion, for example, I'd have with a client. I'd say, you've made this much profit. I recommend we do this. What do you think?
Yeah.
The other thing too is every company, and I'm going to say partnership, I'm going to say a partnership should have a partnership agreement. A company should have a shareholders agreement. Vitally important. If you don't have a shareholders agreement and one of those shareholders dies, you're stuck. Because if shareholder A dies, their shares go to its estate. And its estate may be their partner, the personal partner at home. They may not be married, may not have a spouse, so it just sits in the estate. And all of a sudden this company is trying to run with lawyers running owning the shares in this company, or the wife or spouse owning the shares in that company, and they don't know anything about how to run that company. So that can be a bit of a problem. With a shareholders agreement, you actually stipulate what happens if one of the shareholders dies. You'd have an insurance policy taken out on each shareholder and saying, okay, if you die, then we agree to pay this money to your spouse so that we can have the shares back. And also, a shareholders agreement can stipulate who's responsible for doing what within the company. That's really, really important. And what happens if we want to dissolve this company? And the really most important thing about a shareholders agreement is that all the shareholders sign it. I've seen shareholders agreements drawn up and no one signed them, and then something goes wrong, and that's all very well, yeah, we had an agreement, but it wasn't signed, so it's not legally binding. If you're just you on your own, you don't need a shareholders agreement in a company. Husband and wife company, it's really up to you. If there was a marriage split, the shares would come under matrimonial property anyway, so there's no issue there. But it's more if you're going into business with external parties. And definitely a partnership, you would have a partnership agreement if you're going into business with external parties as well. Now with taxes, a company tax rate is usually a flat tax rate, so it'll be a straight, at the moment we're at 28%. And that's 28% from the first dollar. It's not staggered like an individual tax rate, it's 28% on the first dollar earned of profit. So in that respect, my job, I'll look at that and I'll go, okay, 28% of that, or do we go split it in here at the lower tax rates, but then it would depend what other income each shareholder has. And there's nothing wrong with doing that. I'm not trying to get the best tax deal, I'm just seeing what works. With the company tax, it's the company's responsibility to pay it. And again, company or partnership or whatever, I'd still recommend that you put money aside for tax savings. Because if a company ends up owing provisional tax, the tax department would want that company paying that tax as soon as it earned that money. So if you don't, and you don't know how much you're going to earn in your first year of business, it's like crystal ball gazing. So if you've saved that money, you could either pay it into inland revenue early, or just wait, and then they do have the ability to charge use of money interest. Because a company is not a person, so therefore they consider that the companies have the use of the IRD's money whilst trading.
When you talk a bit more about provisional tax? Does that come up?
Yeah, I will talk a little bit more about that. It's quite it's hard to get your head around, but I will tackle it, and then you'll all sleep really well tonight.
Okay.
So you can also run a business under a trust. With a trust, again, it's a flat tax rate for a trust. You have to have trustees, you have to have beneficiaries. Anytime you make a business decision, you've got to do a resolution. So unless you're really passionate about running a business under a trust, I would say don't. Trust, I like trusts to owning the personal property, nice and simple. A trust can be used for a rental property, that's fine, because you're not making major business decisions all the time with a rental property investment. But if you're going to be doing a business that's trading like a retail store or trading all the time, you really don't want a trust structure. A trust can own the shares in a company, that's fine. A partnership can own shares in a company can own shares in another company. What I'm trying to get across today is that when you have a business idea, you need to look at your structure first. Don't just go, oh, I'm going to do this, and then 6 months later go, oh, I wonder if I should have done a company or a partnership. It gets messy. So if you can, go talk to someone first. Want to do this, what structure should I have? Obviously business can grow over time and it can change, and you may need to change your structure later. That's fine, perfectly fine, and I would always recommend you change it at the start of a financial year, because if you go from a sole trader to a company, then you've actually got the problem of two sets of accounts, because that's a separate person to this person. Even though it's the same business flowing through, it's still a separate person in the eyes of the law.
Whereas partnership to a company, it would be
Still
easier.
it's still a separate business in the eyes of the law, separate person.
Yeah.
So the best bet is to have the dialogue with your accountant coming up to the end of the financial year and go, hey, we've been running this structure, not sure it's working, what do you recommend? Change it, go forward for the start of the next financial year. And that's easy.
Setting up your financial year, I'm pretty sure will be so you can finish at the end of June.
Depending on, you probably can because of your industry,
I'm
yeah.
pretty sure you can.
Yeah.
You'd be best to setting that up from where it goes.
Yeah.
Yep.
Absolutely. Yeah. Does anyone have any questions on those structures? I'm not going to get into trading trusts, as what I said, a bit more complicated. Okay. So what I'll do is I'll just talk a little bit about tax. So in this scenario here, sole trader, $20,000 profit, okay? Taxes paid on that. Now at 10%, that's going to be $2,000. So I'm just going to say 20%. It's not that's the incorrect tax rate for that level, but I'm just making it easy on my brain tonight. If everyone's happy with that. So if we do 20% tax, $4,000 to pay. Currently in inland revenue terms in New Zealand, if the tax is over $2,500, you will be paying provisional tax. Now, in my mind, and I don't know about you, but $2,500 in tax is not a lot of tax to pay in 1 year. So a lot of people end up in provisional tax without realising it. So what happens with provisional tax is that you will pay that again in 3 equal instalments in advance for the next tax year. So this is year 1. made $20,000 profit, so I've been going for a year, 31st of March 2014, rolls around, done, books done, tax of $4,000 to pay. You would think that you would pay that now, correct? No, IRD will give you a year to pay that. So you have one whole year. So what that means is that me as your accountant would send you a letter just before you have tax to pay, and you go, why am I paying tax? Because I told you about that about 6 months ago that it was coming up. A lot of people forget that they've actually got that tax bill because it's a year later. So we call this terminal. Well, actually, I don't call it terminal. IRD calls it terminal because it will kill you. No, it could. So yeah, it's called terminal tax. I'm sure there's another reason for that, but I just think it's because it's a shock. And then you have provisional tax. Because you're providing for tax in advance, that's why they call it provisional. And that IRD is going to want that plus 5%. In advance, before this one's due. So in your first year, you've done year one and you go, I haven't had any tax to pay in year one because you haven't physically paid it. Year two comes around, you probably make a similar income, but in that year two, you've actually also got to come up with some tax to pay. So paying for the tax for the year gone, paying for the tax in the year to come, based on the year gone.
Plus 5% buffer.
Plus 5% buffer because they expect you to increase your business by 5%.
Right.
Clear as mud?
There's mud. So that'll, the 5%, I mean, this is all just projections, so if it's less, more, whatever you pay a difference or you get a tax refund.
Correct. Absolutely. So year two rolls around. And, lo and behold, you've made the same profit. Just because I'm making it easy on my brain today. Oh, that's $4,000. Tax, actual tax. Oh, but I've paid $4,000 plus 5% already. So my terminal tax is done. And I'm actually got a little bit extra back because I paid an extra 5% and I didn't grow my business by 5%, so I've got a bit of a refund. But because it's still over that $2,500, got to pay some more provisional in advance for the next year. But as you notice after year two, because I've repaid this in advance, I'm not having to come up with $8,000 in one go. I'm only just going to come up with about your $4,000 or plus the 5% again. And these provisional tax payments are staggered. They're 3 times a year. So you can cash flow, prepare yourself for it. But as you can see, if I'd saved 10% of my income from day one, after that first year I'd have $5,000 saved. And I'll be like, oh, well, that's okay, because I've got enough of that first provisional tax payment. I'll just keep saving my 10% as I go, and I'll always have that money there.
And would you ever because you can pay more provisional tax than
Yes,
what you're required to.
yes.
Like you can opt
You
to.
would,
You can voluntarily pay.
You'd only do that if you really were anticipating that the next financial year you're going to make significantly more, or
Absolutely.
yeah.
Or you can estimate it at nil if you think you're going to make significantly less.
And I guess the other option is to just pay what is required and then put aside that.
Yeah, absolutely.
10%.
So you've got options.
Yeah.
With a company, as I said before, same situation applies, but if you hit provisional tax, they're going to lump use of money interest on top. Use of money interest is tax deductible, so you can claim it as an expense. So that's a good thing. But it's just another thing to factor in. So where I'm going again with all of this is you've got to have a good accounting system. You've got to have something that will give you information on a daily basis and as you're going. So you can actually keep an eye on that profit. You know how much you've got saved for tax. Doesn't come as a surprise.
So when you're mixing it all up, like in my case, regular day job or that.
That's fine.
plus-
Your regular day job's taxed as you go, so you're fine.
So it's only the
Yeah.
business side of it
Yeah.
that I need to worry about.
What will
Even
happen?
though it's all under the same IRD number when we get
Yeah.
returned.
What will happen in your case? I mean, if you made a loss in your first year, which I suspect you will,
Yeah.
you'll pay tax with your regular day job.
Yeah.
So that tax will go. You'll end up with a tax refund because
Right.
yes, Year 2, I don't want you having a tax refund because it means you're not making any money out of your business. So you'll then pay a top-up tax.
Yep.
But what it means is the money that you're earning through your day job does get added to the profit. So it could put you into a different tax bracket. But then you'll just pay the extra tax when your tax return is done. But if you don't have an accounting system where you can see what your profit's doing on a day-by-day basis or even a month-by-month basis, you're flying in the dark.
What accounting systems would you recommend?
Xero.
Why?
I like Xero.
Yep.
Because I can see what my clients are doing. Because I can log into it too. If there's any questions, they can leave questions for me in email, say I've got some things to discuss, and I go and fix it. I can check the GST if they want to check the GST. And I don't have to go to see my client. They don't have to bring stuff to me. They don't have to send me stuff via the internet. They just go, email, can you check it? And I can go in at my leisure and check it because it's in the cloud. MYOB is also going through that. They're going to put that through the cloud, and it's the same thing. Xero is just a little bit ahead of MYOB at this point. That's why I like it better.
Yeah, so I'm not familiar with Xero, but it's a pretty straightforward system.
Absolutely. Ask Mark.
Yep.
But it's not free.
No, it's not free.
Isn't it?
No, there's a monthly fee, but MYOB has a monthly fee as well. There is a monthly fee. What I do for my customers, I pass on a discount if one is given. So if you're on the larger package and it's advertised at $50 a month plus GST, I get a 25% discount and I filter that through to the customers. I don't clip the ticket on the way through.
It goes back to what you said on the very first session on the expenses.
Mm.
You're the expert, so why am I going to waste all my time
Exactly.
and get an accountant to do it manually?
I so don't want to do it manually.
I don't know.
And if I've people turn up with plastic bags or shoe boxes full of receipts, I look at them and say, really? Are you sure? Because it'll cost you. It's an easy system to use. But there are other things out there too. I mean, you can do a spreadsheet.
About QuickBooks, is that not very popular anymore?
QuickBooks. I don't like QuickBooks.
Yeah, I think a lot of people do. My husband
But
used to use it all the
I
time.
can work with the printouts.
Right.
Don't ask me to run it, but you print off all your documentation off QuickBooks, not a problem. Can read the document, so that's perfectly fine. So QuickBooks is, any system really is fine, to be perfectly honest with you.
From your perspective, what do you need produced, given to you to be able to
Okay,
do
yep.
your job?
So if you're running your own accounting system, a copy of that,
Mm-hmm.
or printouts.
Yeah.
If you're on Xero, you just give me access to, you just say invite me in and I can see everything there. Bank statements would be handy, especially to verify the closing bank balance at the end of the financial year. Debtors and creditors, but if you're using Xero, they should be already in there. So people that owe you money and you people you owe money to. Stock take, so if your stock value is over $10,000, I need a stock take done. Not sure how you do that with honey, but I guess it's not stock unless it's in the barrels, is that right?
Yeah.
So that's fine, so you just count the barrels and then put a value on that. Home office, which we discussed the other day when we looked at business expenses, so I need to know details of your home office costs. Some people say, oh, it's just the same as last year, but power goes up, rates go up, those sort of things. So it's not necessarily the same as last year, so it's quite good to get the actual figures through.
My personal thoughts on it are that I personally want to know as much where money's going, where it's
Mhm.
coming in,
Yeah.
because that way I have a better understanding of where I can cut
Yep.
expenses and
Absolutely.
increase profits, which probably makes your job easier, but it also minimises what you need your accountant to do.
I agree.
Does it? I guess that long and short of it, that's reflected in the
bill.
billing
Yes.
costs. Yeah.
Yeah, basically, I'm putting a lot of people onto Xero and probably doing myself out of a job.
Yeah.
I'm okay with that because I prefer to do strategic planning and work with the customers to build their business and make their business better. That's what I do. I don't want to do journal entries anymore. I don't want to be fiddling around with trying to get, oh, your bank doesn't balance, why, and finding it. Don't want to do that anymore. I want to go, okay, cool, your business, all the information's there, why are they losing money? Let's have a look. That's what I prefer to do.
Because I imagine in the scenario where we're a client of yours,
Mhm.
it's not necessarily you that's going to be doing the
No,
paper trail.
No,
That's
it's
all
not.
good. But at the point where we go, hey, look, can we get together, sit
Absolutely.
down and have it?
you'll meet with me.
Yep.
And that's where I'm taking my business. That's how I've structured it, because I listen to my own advice and do what I enjoy doing and farm off the stuff I don't enjoy doing. Yeah. So I think I might do 1 or 2 GST returns for clients now instead of all of them. Mm. But that's what drives me. That's what I'm passionate about is business, and I want to see why is this business doing really well? Why is it not doing really well? What's the percentage of expenses versus your turnover or your income? Because there's certain parameters that you should be working within in the business. I mean, you want to be taking at least 1/3 of that profit out into your back pocket through a profit, making a profit, for example. At least 1/3 of that should be yours. And if it's not, okay, we need to look at where the costs are. Are you paying people too much? Are you paying too much for your product? Is your product not priced properly in the market? Or have there been market factors that have affected your earning income? Because there's been, a global bee crisis or something, or something like that. Those sort of things. Or Marg's business might go through the roof because unfortunately there was a natural disaster and there's a lot of funerals.
With the, you're talking about
Sorry, but
Or it could be lots of babies born.
could be lots of babies born,
And they
absolutely.
need to name them.
That's correct.
before when you're talking about your stock take, what's the, where does that fit into your taxation?
So what happens is the value of your stock at the end of the financial year is basically considered income
Yeah,
to you
okay.
because it's stock available to sell.
Right.
So if you have a retail store, you don't want to have a lot of stock. That's why you see at this time of year, stock take sale on the TV and things like that, because they don't want to be holding a lot of stock to be counted, and because it also becomes income to their business. So your stock take does become income. So if you are running stock, you really, really don't want to be holding a lot of stock, like if you're selling stock to people.
So you pay tax on your stock, then at the point where you sell that stock, you pay tax
It becomes
again?
income, but what happens at the next end of the financial year, the stock that you had last year becomes opening stock, so it becomes an expense. So you're not paying tax on it twice.
Yeah.
All the fact is that you're paying tax in the first year on stock you haven't sold, but then that gets reversed out the following year and offset against the stock you sold, so you're not going to pay tax twice.
So if you can afford to hold on to some of that stock, pay the tax on it, accept that you'll get the tax back
Mm.
when you sell, or
Yeah,
as long as it kind of
balance it out. Yeah,
books balance out.
Yeah. yeah, that's right.
Then you can do that for as many years as you wanted.
Correct.
Yeah.
And the same with people that owe you money. If they're people that owe you money at the end of the financial year, that's considered income,
Oh,
even if they haven't paid you. So the debtors are added to your total income.
right.
But also the people that you owe money to, your creditors, are counted as expenses even if you haven't paid for them yet.
Unlikely scenario, but if you hold your stock for multiple years, you pay the tax on it each time?
Yes, but then it gets reversed out each time. So then if the first year it will hurt, but after that it will probably balance
Just
out.
it's
Yeah,
crossing over.
crossing over.
Yep,
Yeah,
right.
exactly.
But if the value increases or decreases, then your tax.
Changes.
Changes. Correct.
Just so you
But no, I'm just curious. No, it's quite a legitimate thing. But because if your value decreases, then does that mean the amount that you're getting back was still based off what it was?
Well, if you're holding the same stock each year, you've actually got to value at the lower of cost or net realisable value.
Yeah,
So if the cost is still lower
yeah,
each time, the value is going to be the same.
yeah.
But if somehow they decide, the government decides, oh no, we're changing how everyone values their stock, that's going to affect you.
Yeah.
And that happens a lot with farmers because they come out with different values for herd, for the herd or whatever. And so farmers are forever having to juggle numbers as well, and it's quite different that way. Has that helped explain provisional tax?
It has, yes.
Oh, good.
It's not so ridiculous after all.
No, it's not.
The idea is ridiculous, I think.
The idea is quite ridiculous. I do believe so.
Yeah, but it was a good explanation.
You think?
10 points.
Thanks. I personally think that if the Inland Revenue considered letting a sole trader pay tax on a monthly basis, they would get their money quicker
Yes.
and it would help with cash flow and everything else. Right. Any other questions? Because we may have to end this session.
No.
Excellent.
That's very clear.
Next week, I'm having an insurance person come along and talk to us about business insurances. His name's Brent, and he's going to be here at 7. He's going to take the first little part of the session. So if you have any insurance questions, bring them along.